Good day, friends. Today I want to share with you the main rule of trading, which I learned more than 20 years ago and successfully apply to this day. The main rule is to limit the loss, limit risk when trading stocks, futures, options, in general, all financial instruments. We come to the stock exchange to trade and get an increased return to our capital. Our capital is our primary asset that we risk with while trading. Instead of putting our money in the bank and getting a small return, we go to the stock exchange and try to make money to get an increased return. Stop loss is a strict necessity and the main rule of trading. Next, I will tell you in details how to use stop loss with futures and options. Suppose we expect an upward move in Bitcoin futures. Right now the price is 29,705. And let's assume we buy futures on 1 Bitcoin, 1,000 contracts. So now we can see the P&L of our futures. And now we have to make it clear for ourselves what is the maximum loss we're willing to incur. Let's say we expect the price to exceed 30 and go to the 31 or 32 level, and then we can make over $1,000. But what is the maximum loss we're willing to incur? We need to set a stop loss so that we don't lose more than we're willing to. Very often I hear all kind of stories from clients and traders. So there is a fall. The client skipped the stop loss, sits in the long position and expect the price to jump back. The jump back does not happen. The trader incurs even more losses. He hopes that the market will turn around, but the market does not turn around. The trader is not alone. He and many others are under bear pressure. Long positions incur significant losses. In the major crypto exchanges, liquidation happened, causing the price to go even lower. Traders lose all their funds, all of their deposits. By the way, there are no such liquidations on the AE exchange. Risk management is more sparing here. If there are not enough funds for margin requirements, a margin call is made and the position is limited, but not liquidated. You have to plan very clearly and understand at which futures price you will get a margin call. Options are much simpler than futures. You open a position with the call option of strike 31 for 1,000 contracts. And then you can clearly see the maximum loss on the chart, which is the premium of the purchased options. In this strategy, it's $563. There is no problem with options, but it is important to never buy. Do not get into long positions if the amount of risk is greater than you're willing to bear. Let's say your deposit is $10,000 and you're willing to make a risk with $500. That's acceptable. When you use strategies like vertical spreads, you get an automatic take profit. You eliminate the human factor, and at the time of expiry, you know exactly how much your profit is. You also know exactly what your maximum risk is, and you can reduce it by selling long call options, level 33 for example. Moreover, there is a chance that you will not make a profit or a loss, but you will get some futures if the price is somewhere in between. Options are easier to work with than linear instruments. So my advice is to always limit your risk. Use a stop loss. Let's say you are selling Strangles, like this one for example. The strategy is popular with the expectation of getting a time premium for the sold options. Let's say you don't use delta hedging, you don't use rolling. You still need to understand what your maximum risk is. Always compare your maximum risk to your potential profit. If you are happy with the conditions, lock in the risk, otherwise you will suffer from even greater losses. Even if you use rolling, you should still limit the risk. If the return is not greater than the risk, you should definitely not enter such a position. As a rule, the return should be several times greater than the risk. If we are talking about trend strategies, if you are working with an up or down move, you have purchased a vertical spread, then its risk will be at $145. $855 is profit. The profit is almost 6 times the risk. If you are betting on growth, this strategy is suitable. If you trade linear instruments, put automatic closing of the position when the price reaches the maximum risk for you. This is the rule I wanted to talk about today. If you liked the video, please give it a like. Ask questions. Tell me which topics you're interested in. If you haven't subscribed to the channel, subscribe. I wish you all the best. Successful options trading.